what really matters to the balance sheet is the concept graphically, you can see here, that instead of calling it assets, we're going to rearrange it into what we call operating assets and non-operating assets, right? And then for liabilities, we're going to rearrange the liabilities into the debt equivalent liabilities, the threes, and the operating liabilities, the non-interest bearing liabilities, right? And then if the company did have some non-operating liabilities, we would also break that out separately. And then we'll have the equity cash flows. So that's the idea, is that operating assets minus operating liabilities, which is what we'll call invested capital, plus the operating assets minus the non-operating liabilities that any existed, would be the total funds available to investors. And that has to equal, by definition, the debt and the equity, the interest-bearing debt and the equity of the firm. Okay? So that's the rearranged balance sheet that we're about to rearrange. So here's the example they gave in the book. So the idea is this is a very simple balance sheet on the left. We're going to create the balance sheet on the right. So I recreated this simple balance sheet in Excel, so we can quickly go through the process. Now, this next step, you don't have to do technically, but I strongly encourage you to pay attention to it because it will make your lives easier, which is the concept of labeling. Which is eventually when you do this, it becomes intuitive to what's operating, what's non-operating, what's debt, what's equity. But as you're getting used to the process, this is where I found the labels to be helpful. So the first thing that I recommend doing is labeling the statements and labeling each item a 1, 2, 3, or 4, just so that you can keep track of which bucket you're eventually going to move it into. So let's start out by labeling this simple balance sheet in the PowerPoint example. So inventory, operating, non-operating, operating. So we would label that a 1. Net property, plant, and equipment, operating, non-operating, 1. Equity investment, I'm spending on a joint venture, 2. So it's an asset, but I don't control it, and I'm not using it to sell to my customers. Accounts payable. Because accounts payable is primarily funding what? Operations, but specifically, what part of the operations is usually most of the accounts payable showing up on the balance sheet, on the asset? The liability of the accounts payable is funding what asset, primarily? Inventory, for most companies. Therefore, accounts payable has to be operating because it's funding the operating inventory. Debt, bank debt. 3. Even though it's a liability, it's an interest-bearing liability, where an accounts payable is a non-interest-bearing liability. 1 versus 3. Common stock at par value. 4. It's equity cash flow. Retained earnings. 4. That belongs to the shareholders. Unpaid profits. So we quickly label our statement. So here's what I would then suggest for your homework assignment, because your homework assignment is basically going to be, here's a more complicated income statement and balance sheet, convert it. Okay, so what I'm about to do is your homework assignment. And by the way, is your midterm exam. Right? That is your midterm exam as well. So what I'd recommend is creating a new tab for every statement. So I'll call this TFI. And that also allowed me to cut and paste. So what I'll do is I'll copy and paste I'll copy and paste these here. And then what I want to do is I want to aggregate all my 1s. All of my 1 assets against all of my 1 liabilities. So what are my 1 assets? Inventory, PP&E, and accounts payable. So, what is invested capital? It's the assets minus the liabilities. That's how much invested capital I have in my business. Okay? Now, convention. For purposes of your homework assignment and for purposes of the midterm exam, this is fine. Assets minus liabilities. However, right after the midterm, actually starting next week, we are going to get into forecasting financial performance. And so I'm going to forecast that my current assets, my working capital, grows at a different rate than my long-term assets. So you might want to start doing it now, but you don't necessarily have to. But the idea is this, that what I'm going to do is I'm going to take my current assets and net them together, and that is going to be something called operating working capital equals assets minus liabilities, and I add the working capital to my long term, and that is also my invested capital. Okay? Either one is sufficient for now, but eventually we're going to do it this way. We'll put the current assets net against the current liabilities, long-term assets against long-term liabilities. But nonetheless, that is invested capital. That is how much money I'm tied up in running my operations. My working capital, my PP&E. Questions? Yes?
Property, plant and equipment, right?
Yep.
So the whole sum, if you
buildings, land, all the equipment inside them. Yeah.
But they are long-term investments, right? So how can we add the whole thing? Like let us say, for example, you spend $1 billion in purchasing different equipment, which is going to be for 10 years ahead. So how can you add that whole thing and as part of operational?
Well, what you're saying is exactly that. I spent $1 billion on my operations, and I had to finance $1 billion. So put $1 billion on a credit card. The bank is going to start charging you interest the second you put the $1 billion purchase on the credit card. They're not going to say, oh, it's going to be 3 years before this plant actually gets into service while you build it. They're going to start charging you interest the day you spend the money. So that's really the point of, if you really think about it at its heart, what we're talking about here in financing, is the debt and equity clock starts the second that you take the money from the debt and the equity holders. And so therefore, they're going to want to get paid today, even if you're using that money over a long period of time. So the way that you actually owe the debt and equity holders less money, don't borrow $1 billion today. Borrow $200 million today, and then borrow $100 million next year, and $100 million thereafter, rather than $1 billion all at once. But the point is, net PP&E says that you have borrowed and have not yet paid back $300 million that's tied up in facilities. You need to earn interest on this, or earn a return on this, because I'm charging you interest for this, right? So therefore, that's kind of the way that we're structuring the statement, right? So then I want to add in any non-operating assets. So anything labeled a 2, equity investments. Any liabilities, I would then subtract, just like accounts payable. I don't have any, and that would give me something called total funds available to investors. My 1s plus my 2s, invested capital plus equity investments, is my total funds that I basically have financed. Sure, total funds invested, TFI. This is what I financed. This is how much money I need. And that was financed either through debt. So here's the debt that I financed, or equity. Here's the equity that I financed. And if I sum these up, notice the balancing. So in every assignment this semester, you will have to show a balanced set of equations. You will have to show that your TFIs add up. And if they don't, you do not have a correct answer. So let's just say that for whatever reason you forgot to put in common stock at par value. You got a Lego on the floor, right? I didn't get every item accounted for off my balance sheet. Well, guess what? My statement doesn't balance. Now, let's say that you told me that you had a 50-50 chance of one of these two numbers being right, and you guessed that this was the right answer. For purposes of this class, you still have a wrong answer. The only way you have a right answer in this class is if you have the right answer and it balances. So if you have the right answer and it doesn't balance, then you got lucky that you happen to choose the right answer. That is not a correct answer. So you have to balance. And that's the point. I know I have a mistake here because it doesn't balance. And that's why I like the labels, because the labeling helps me make sure I balance, because I could go through and I could say, all right, I got 3 1s, I got 3 1s, I got 1 2, I got 1 2, I got 1 3, I got 1 3, I got 2 4s, oops, I forgot a 4. So by doing the labeling process, it actually makes your life easier when you make a mistake. Because when you're looking at a lot of data on your page for your homework assignment and you can't figure out why your statement doesn't add up, then making sure that everything is in the right bucket is important, because typically the mistakes come from one of two methods. You either forgot to put something into the statement that should have been there, or you added something you should have subtracted, or you should have subtracted something you added. So you did the math wrong. But I want to eliminate the fact that I put everything there before I get into did I have the proper signs. So just as a more structured way also of helping you when you try and balance these statements. Okay. So let me put my common stock at par value back. And that is the TFI. Questions? All right, statement number 2, TII, total income available to investors. This is the rearranged balance sheet, income statement. We just did the balance sheet. So again, I'm just going to carry over the labels just so that when I eventually create my cash flow, I have all the columns in the right years, just to make my life a little bit easier. So again, I want to label my year 2 income statement 1, 2, 3, 4. Now, on the McKinsey income statement, which this is based, which is going to be slide here in the financial statement, revenues, operating costs, and depreciation are all operating. Okay, we assume revenue comes from your customers. Operating costs support the revenue. Depreciation is the net PP&E that supports your plant and equipment. That's all operating. If you subtract all of that, you get something called your operating profit or your EBIT. So therefore, I'm going to let us make an assumption that operating profit is operating, and instead of doing all three above it, to simplify by starting with operating profit on an income statement when we do our no plat. So let's just look at operating and non-operating here. But as I said, I can, just so we can see everything, I have revenue, I have operating expense, what was it? The numbers, 1,000, $720. Okay, so I'll start out with operating income as my 1, which is a proxy for the 3 above it. What is interest expense? 1, 2, 3, or 4? Operating, non-operating, debt cash flow, equity cash flow. It's actually a 3. Because it's going to the debt holders. What is non-operating income?
You ever earned interest income? 2.
So is it operating or not? 1 or 2? 2. In this case, since the simple balance sheet didn't have any cash, where did it come from? This non-operating income came from where on the balance sheet?
Equity investment?
It came from the equity investments. And the equity investments were non-operating on the balance sheet, which means the income from the non-operating item should be non-operating on the income statement. That's the other thing, is that we have to have consistency between the statements. Net PP&E is operating on the balance sheet. Depreciation has to be operating on the income statement. Debt is a debt cash flow on the balance sheet. Interest expense has to be a debt cash flow on the income statement. Excess cash. It's not on here, but if we had excess cash, would that be operating or non-operating? Non-operating. And then, if we had interest income, what would we call that? We'd actually call that non-operating. So that's another thing that a lot of finance people will do, is they'll net the interest expense. But what they're really doing is they're netting something that's non-operating with something that's a debt cash flow. And we're going to split those out separately. Okay? So, back to this. I've labeled through non-operating income, taxes. Taxes are operating. Taxes are non-operating. Taxes are debt. This is the other thing that we're going to do. We're going to split the tax impact into each of the areas. So it's not that taxes are operating or non-operating. It's we're going to look at the operating impact of the taxes, the non-operating impact of the taxes, and the debt impact of the taxes. So we're going to look at the tax impact in each of the areas. And we're still going to end up with the same taxes that we paid, but you'll see that it gives us a much more particular insight into how the company's performing. Net income. Who's that belong to? That's 4. That goes to the shareholders. They get what's left after everybody else has been paid. They get the income. That's the end of the income statement. That's the end of TII. Okay? Dividends is something that we will eventually deal with, but here's the thing. Dividends are not part of the income statement. Part of the cash flow statement. Okay, so income statement ends with net income. All right, so back to TII. I want to start by getting all my ones together from the income statement. So in this case, I start with my operating income. Now, I would have tax on operating income. I believe that the tax rate that they used, because we can kind of see it off the income statement, is 25% here. 70 over 280 is 25%. So therefore, on our statement, I would take that times 0.25. And then that would get me something called no plat, which is my operating profit minus the taxes on the operating profit. That is my no plat. And that's the operating tax that I pay. So what no plat really says is if I earn this amount of operating profit and I didn't have anything else and I reported that to the IRS, how much taxes would I have to pay? And the answer is they're going to want 25% based on the tax rate this company's paying. So 25% of 280 is the 70. So 280 million of profit, 70 million of taxes, 210 million of no plat. That's how much operating profit after tax, some people call this no pat, that I would earn. Yes?
So what about like the interest tax shield? Does that even factor in all?
We're going to get to that when we get to the debt equivalents. So that's the point. We're going to look at the tax impact of each area.
Okay.
All right? So now let's do the non-operating items. Equals financials, anything that's a 2, non-operating income. Right? But here's the thing. If we report $4 million of non-operating income, we're going to have to pay taxes on that non-operating income. So tax on non-operating income is going to be 25% of the non-operating income. That's 2. And then we're going to get after-tax non-operating income, which is the 4 minus the 1, or the 3. So what you see here in the book example is they just netted out the 3. Because the guy that wrote this chapter at McKinsey, it's second nature to him that you just net out the taxes. So he knew to multiply by 1 minus the tax rate. But it may be helpful for you as you are building these statements to do what I just did and say, look, I have my pre-tax profit. This is the taxes I would pay. This is the after-tax impact. This is the after-tax profit. Because that's how they got to the 3. Okay? So what is my total income available to investors? It's the no-plat plus the non-operating income after tax. It's the 213. That's the same as the 213 in the book. Right? Now, we're going to go back to your point. Next, I do my 3s and 4s. What is my debt cash flow? Well, my debt cash flow is my interest expense. But what I'm going to have is an interest tax shield because I can deduct the $20 of interest expense. At 25% tax rate, I can deduct 25% of the $20, so I will get $5 in interest tax savings. So my after-tax interest expense is the 20 minus the 5. It's 15. So I have $15 million of after-tax interest expense. Questions? But that goes back to your question. We actually list the after-tax interest expense by breaking out the interest expense and then the tax shield on the interest. We break it out separately, right? And then we have the equity cash flows. Off the income statement, we only had one. That was the net income. That's my 4. When I add my 3s and 4s together, equals my 3s plus my 4s, 213 equals 213. My TII balances. So that's the point. Profit from operating activities, profit from non-operating activities, total income that I could pay to the investors. How much was paid to the debt? How much was paid to the equity? That's the structure of this statement. Now, let's talk about taxes. How much in taxes did this company originally pay? 66. How much taxes do they pay in operating activities? How much taxes do they pay in non-operating activities? 1. What's 70 plus 1? How much taxes did they save by having debt in their capital structure? What's 71 minus 5? We still end up with the same taxes. But here's the point. We now get insight into the tax impact by every area. We see that because the firm had debt, they otherwise, if they didn't have debt, would have paid how much in tax? 71. So there is a value to having debt, and what we've done is we've quantified that value. By quantifying that value and forecasting that value, we get the APV model. That's the other nice thing about when you reorganize these statements. It then makes it easier to do these multiple models because we've just forecasted out the tax shields. So now we can actually do the value of the tax shields separately than the value of the operations of the business, value of the free cash flows. So now you got the structure to do the APV, right? Yes?
So I may have missed this earlier, but the 0.25, how did you get that number to multiply?
Tax rate. So what I did is I did it by eyeballing it, but if I go back to the financials, this was the tax on the profit before tax. So they gave us the tax, they gave us the profit before tax, and equals that divided by that is 25%. So basically, that's the key. We have to end up with the tax the company pays. Therefore, what we're going to use is what's called the tax rate. What we actually want is what's called the cash tax rate. Because what we really care about is the company has any deferred taxes, then those aren't cash taxes that are paid. So we actually have to look at the cash tax rate. And then we apply that cash tax rate to everything. And then we'll have the deferred taxes, if we had any. We'll have the debt savings. We'll have the operating. We'll have the non-operating. And those go into all four areas. Okay? So, and that's the point, is that we are just taking the same taxes, we're just putting it into the various areas of the firm. Rearrange the income statement, rearrange the balance sheet, they both map to M&M. These two statements for your homework assignment, you probably won't have too much trouble with. This next statement, you're going to have trouble with. It's called CFI, which is the cash flow statement. Cash flow available to investors. Now, again, I'm going to copy over the same years. Now, here's the thing. If I go back to PowerPoint, what I'm doing here in the CFI statement is I'm taking the income statement minus the change in the balance sheet, and I'm going to do that 4 times. I'm going to do it for my 1s, for my operating items. I'm going to do it for my 2s, my non-operating items. I'm going to do it for my 3s and my 4s. Income statement minus change in the balance sheet. Conceptually, that's what we're about to do. So, income statement equals total income available to investors. It's my NOPLAT. And that was my 1 cash flow. Except the NOPLAT isn't really the cash flow off the income statement because of what? Depreciation, because we subtracted a non-cash item. So we got to add, since this is the cash flow statement, we have to add back depreciation. So the very specific definition of gross cash flow, as it's called, is NOPLAT plus depreciation. That's the definition of gross cash flow. That's the cash from the income statement. Right? Now, minus cash used in the balance sheet, minus change in the balance sheet. So that becomes something called gross investment. The definition of gross investment is current year's invested capital minus previous year's invested capital plus current year's depreciation. That is gross investment. And that gets us something called free cash flow, which equals gross cash flow minus gross investment.
Can you do gross investment?
So, if I take my start PP&E, well, the shortcut for gross investment equals change in invested capital plus depreciation. That is the shortcut for gross investment. That's what we're doing right here. Now, you might say, why am I adding back depreciation? Let me show you the granularity of the gross investment. So what is the gross investment? It's really the change in working capital. So working capital went from 75 to 75. So there was no change in working capital. So there's no investment in working capital. And we can eyeball this, because if we go back to the original balance sheet, basically inventory went up by 25, but payables went up by 25. So we didn't pay for any of the inventory that we just bought. So there was no cash impact on that. Everybody see that? So change in working capital was basically zero. So the other part of my ones off of my balance sheet is my PP&E. Well, change in PP&E is called what? Capital expenditures, or Capex for short. And what is the definition of Capex? Well, Capex equals current net, what is it called? Next year, or call it PP&E for this year minus PPE last year plus depreciation. Or starting PP&E plus Capex minus depreciation equals end PPE. That's just accounting, right? So if I rearrange, as I said, Capex equals my end PPE minus my start PPE plus depreciation. It's easier to see it that way. Everybody see that? So that's the point. What is my capital expenditures? Well, what is my ending PP&E? It is 350. What is my beginning PP&E? It's 300. What is my depreciation? It was 70. Add the two together, gross investment of 70. What is free cash flow? Gross cash flow minus gross investment. So there's two ways to get to the same answer. One is what I call the shortcut method. Well, what is the shortcut method? It's the change in the invested capital plus the depreciation. Where's the plus depreciation coming from? It's coming from the Capex. Why are we solving for Capex? And why are we not using the Capex that the accountants give us in the statement of cash flow? And that's because, unfortunately, particularly in the last 10 years, Capex that the accountants report is not the actual Capex that the company spends. And here's what I mean by that. For whatever reason, the income statement is supposed to be the change in the balance sheet. That's really what the income statement is, right? We have a starting and an ending point, and how we got there, the income statement explains how we got there. But here's the problem. Accountants have started making direct adjustments to the balance sheet that do not show up on the income statement. And that causes problems because the income statement is supposed to explain the change in the balance sheet. And if they just adjust the balance sheet and they don't show that impact on the income statement, then it messes things up. And they have this fourth statement that has now become more important, which is the statement of changes in financial position / changes in equity. And then you have to go to this changes of equity statement to see the direct adjustments that have been made to the equity of the business that was not made to the income statement. And that's just a relatively new phenomenon in accounting, that accountants didn't used to do this nearly as much. Now they're doing it a lot. And one of the areas they're making direct adjustments on is the PP&E of the business. So what they'll do is they'll go in and they'll write off the PP&E, but they won't show the write-off as depreciation. They'll just impair it, and they'll just write it off, or they'll end of life it and take it out, but they won't actually hit the P&L. So that's the problem, is that you have to then do an adjustment to the Capex to explain these adjustments where they've impaired assets, which they've then done to then actually explain the change in the income statement. And that makes our life difficult. So rather than trying to use their Capex and figure out if they made adjustments, then what we're going to do is we're just going to look at the change in the PP&E on the income statement, because therefore it would force us to have accounted for the adjustments. Right? So it's really just a way of not having to then make an adjustment for impaired assets by having to go look at another statement, by basically back solving for what the Capex had to be, which 7 out of 10 times the Capex that we solve for will be the Capex that's reported, but 3 out of 10 times you're going to run into the Capex that's reported is different than the Capex the company had because they've impaired assets and they didn't go back and adjust depreciation. So rather than every now and then have our Capex be a number that doesn't get our statements to balance, because that's the point. If I subtract Capex, I got to get a balancing gross investment that gets me to my gross cash flow, and every now and then you can't get it to balance. So what we're going to do is we're going to force the adjustment into our equation by solving for Capex. That's why we're doing this method. In any event, either way, gross cash flow minus gross investment equals free cash flow. I'll put these formulas over here to the left.
Is that another way of saying we're going to gross PP&E to find what the Capex is?
Well, we're not using the gross PP&E, we're actually using the net.
Right, we're using the net, we're getting a gross.
To get to the gross, exactly. Because, as I'm saying, what the accountants will do is they'll go into the gross and they'll direct adjust the gross, but then they won't show it as an impact on the income statement. And again, one of the things that's causing all these problems is something called AOCI. Do I have any accounting majors out here? Adjusted other comprehensive income. That's the problem. Is that increasingly they're using this AOCI as a catch-all to just make direct adjustments to the balance sheet that never hit the income statement. And it's frustrating from a financial standpoint, because then you got to figure out what AOCI adjustments they made. And it's not really transparent if you just look at the income statement and the balance sheet. So that's why we're doing this methodology, very specifically. All right, back to this. So I got my ones. These are my ones. And that's my free cash flow. Now I need to do my twos. Same process. So twos equals TII, start with the income statement, after tax non-operating income. And then I look at any change in twos, so change in equity investments. Now, I have to think about cash flow. So what I'm eventually going to be solving is my cash flow available to investors. All right? So I got to think about my cash flow. 160 adds cash flow that I can pay out to investors. Making $3 million of non-operating income adds to the cash flow that I can pay out to my investors. If my equity investments go up by $10 million, does that add to the money that I can pay to my investors? No. So I either have to subtract it, or if I am going to sum it, I would have to change the sign to a negative, but I have to recognize that that's a cash outflow. I'm spending money on equity investments because I went from 15 to 25. I'm chewing up some cash. So therefore, I can flip the sign because I'm just going to sum these. But basically, I get my cash flow available to investors 153. The first time you set up a series of financial statements, I don't have a good answer for you other than the following, which is you have to apply common sense and think about what direction the cash flow is moving in when you do each line item. So free cash flow makes sense. That's cash coming in. After-tax income, cash coming in. Spend money on a joint venture, that's cash going out. Okay? So I can't treat it by adding that cash flow. I'd have to subtract it in some way. So this is what I'm saying. This is where you'll be frustrated on your homework assignment because you have to think about what's happening with the cash flow. And if you accidentally added this, then you're going to get the wrong answer. Right? And so that's why you have to really think as you're setting this up, what direction am I seeing this cash actually move? Now, here's the other nuanced trick, which nobody asked about, but I'm going to go back to the TII statement to show. On the statement of TII, interest, which is an expense, is listed as a positive number. Right? Now, here's something that, again, can be confusing. These statements are not accounting statements. They're economic statements. They work differently than the GAAP statements. So here's the point of this. Total income available to investors. It literally means that. It's the income that I have available to pay my investors. And the statement has to balance. Therefore, if I have positive income, then the payouts of that income have to be positive numbers. Otherwise, my statement won't balance. Because if my payout was a negative number and my cash profit was a positive number, then I wouldn't actually have a balancing statement because one number would be positive, the other would be negative. So the only way that those two numbers balance is there has to be a choice, and the choice that was made is that profit is a positive number, therefore payouts to balance to the profit also have to be positive numbers. So these economic statements are set up so that on what's called the financing side of the statement or the funds flow side of the statement, payouts are positive numbers. So that's the point. If I lose money, negative profit, I need an inflow of cash into the firm. Inflows are negative numbers. Okay? So if I bring debt into a firm, or if I had a loss, think about it this way. If I lost money on the income side, then I wouldn't have net income. I'd have negative amounts that the shareholders would have to fund the losses. So you have to understand that that's the way these statements are set up. So the same is true on the CFI. So my CFI tells me here's how much cash I have available to pay out to my investors. So any payout to the investor, now that I do the debt and equity side of the statement, is going to be a positive number. Any inflow into the firm is going to be a negative number, right? Because it's going to basically say if I am short cash, I need to go borrow it. Negative cash flow, negative borrowed money coming into the firm. Positive cash flow, have ability to pay out. Positive cash, debt, pay out the interest expense. So payouts are positive numbers, similar to the TII statement. So here's the point. I go to my debt cash flows off the TII, and I do my after-tax interest expense. On the statement of CFI, positive or negative number. Is it a payout?
Yes.
So it's got to be a positive number. Because I'm actually paying the 15 to my debt holders. I'm actually paying them 20 and getting 5 back from the government. But I'm net paying 15 to my debt holders. So it's a positive number, it's a payout. Then, change in debt. My debt went from 225 to 200. So my debt went down by 25. I paid off $25 million worth of principal. Positive or negative number? Positive number. I had to flip the sign. My equity cash flows. Change in common stock. What happened here? Common stock at par value, there was no change. Change in retained earnings. Retained earnings went from
15 to 200.
They went up by 85, positive or negative number? Now, one of the tricks of the statement of CFI is based on the fact that this is now a cash flow statement. And here's the challenge. This is the change in the balance sheet, but there is a change in the income statement on the equity as well. And here's the problem. Net income is not necessarily cash. So I can't, on my cash flow statement, look at the net income and assume it's all cash, because it includes depreciation and non-cash items. And what I'm really looking for is the cash flow paid to the shareholders. What is the cash flow that's paid to the shareholder? It's the dividend. So, trick to the CFI. The cash flow to the shareholder is not the net income. The cash flow to the shareholder is the dividend paid. So, statement number 3 that I do need is I need the cash flow, GAAP cash flow statement, because on the GAAP cash flow statement is the dividends that were paid. And the cash dividend paid was $113 million here. So I need to put in to my CFI the dividend paid. 113, positive or negative number on the statement of CFI? Positive number because it's a payout to the shareholders. So now when I sum all of these, I should get a matching statement. The two sides should match. Because if they don't match, then I do not have a correct answer. Does my statement match? So I do not have a correct answer. What is the mistake that I made? So I made it intentionally.
Making the change in earnings negative.
Making the change in retained earnings negative? All right, let's make it positive.
No, it's the dividends and the change in retained earnings should be netted. Because that's,
So you want to net the dividends and the change in retained earnings? That's not going to give us the right answer either. Here's the thing.
they should go away. The 85 should go away.
The 85's got to go away. Why?
Because you got your net income, you got your dividends, which taken out, so they should just.
Why did we use dividends and not net income?
Because you got your, that's the cash flow flowing to the shareholders.
And what is net income? Is not the cash flow, right?
That's right.
Is retained earnings a cash account?
No,
So a change in a non-cash account has what impact on cash flow?
none.
Exactly. That's trick number 2 to this statement. So trick number 1 on the equity side is it's dividends, not net income. And trick number 2 is you ignore retained earnings, or you basically ignore non-cash accounts, because a change in a non-cash account does not affect cash flow. So when we get rid of the change in the retained earnings, our statement balances. I generated 153 of cash. This is who I paid it to. I paid 15 in interest to my bondholders. I paid 25 of principal to my bondholders, and I paid 113 in dividends to my shareholders. I did not issue or retire any stock. If I issued any stock, change in common stock. Right? If I issued new stock, would change in common stock be positive or negative? Be negative. If I bought back shares, what would that be called? Treasury stock. If I increased my treasury stock, so I had more negative treasury stock as a contra account, positive or negative on the statement? Positive, because it's like a dividend. I'm paying cash back to the owners of the business. But the point is, I didn't issue or retire any stock, so the only cash flow was the dividends. Change in retained earnings didn't matter. So, 3 things when you do your statement of CFI for your homework and your midterm and your valuation projects. Number 1, sides of the statement have to balance. Therefore, cash flows here have to match cash flows here. So, point number 1, payouts are positive numbers, inflows of cash are negative numbers on the financing side of the statement. Point number 2, for equity, it's dividends, not net income. Point number 3, change in retained earnings doesn't apply. So we now have the 3 converted statements. Here's the 4th worksheet we have to do. We got to calculate our economic profit, EP. So, again, I will copy over my years in the same columns. So, to calculate economic profit, I need to know 2 things. I need to know my ROIC, and I need to know my invested capital. Do I know my ROIC? Well, in order to get my ROIC, what I really need is I need my NOPLAT and my invested capital, and that will get me my ROIC. So, do I know my NOPLATs? Yes. My NOPLAT for year 2 is already calculated. My invested capital for both years is calculated off the TFI. Now here's the thing. I am going to ask you for your homework assignment to give me a BOY ROIC or a boy ROIC. BOY stands for beginning of year, as opposed to EOY, which would stand for end of year. So, what does that mean? It means I take my year 2 NOPLAT and I divide by year 1 invested capital. 56%. If I had done the EOY ROIC, I would have gotten year 2 NOPLAT divided by year 2 invested capital. And then if I had done an average ROIC, then I would take the NOPLAT divided by the 2 years of invested capital divided by 2. So, which invested capital I use is going to give me 3 different results. I could either get a beginning of year invested capital, an end of year, or an average. For purposes of your homework assignment, this is the one that I'm going to ask for. Beginning of year. And the reason I'm going to ask for it is that next week when we do our corporate valuation exercise, if we use beginning of year invested capital, we get an exact valuation match between the DCF and the economic profit valuation. That's the Home Depot example. And subtly, McKinsey used beginning of year invested capital. If we use a return on average capital, or if we use a return on invested capital based on end of year capital, we get valuations which are close, but don't exactly match. They'll be a few dollars off. And for purposes of this class, I want you to get exact matches, just to show that you can conceptually get the math right. And then for analysis, we can use other ones, but I'm just saying we're going to calculate a BOI return on invested capital. So here's the point. What is economic profit? I'm going to need a weighted average cost of capital. So I'm just going to make one up at 10%. Okay? I will give you this assumption on your assignment, but I'll give you a whack, so therefore I calculate a spread. Spread is my BOI ROIC minus my whack. So what is my economic profit? Equals my spread times my beginning of year economic, or my beginning of year invested capital. That is my economic profit. Or equals no plat less a capital charge, which is the WACC times the invested capital. So what is my WACC? 10%. What is my invested capital? 375. What is my economic profit? Equals no plat minus capital charge. Two methods, same answer. This is called the dollar method. This is the spread method. Spread times capital. What McKinsey showed you in the book with Home Depot was the spread method. You can also get to it by the dollar method, no plat minus capital charge. Either way, you're going to get to the same answer. And I want you to do both. And as I said, for your assignments, you got to show me both methods. If for no other reason, it'll give you comfort that you're more likely to have a right answer. Obviously, the frustrating part is when they don't balance, right? And that's what I said. Remember the tricks that I told you on the CFI, because that's what you're going to probably struggle with on your homework assignment. Right? Questions by that? Last point that I'll mention, this goes back to last week. This is the morphing of the molten cores example. So if I look at the ROIC, this is operating. But I could also calculate a non-operating ROIC, which is, and here's the point, if I do a beginning of year, equals TII, I have my non-operating income, divided by TFI, I have my non-operating investment. So by putting the statements into the format that we do, we actually have an operating and a non-operating ROIC. And here's the point. If I had calculated a traditional ROIC, which is profit divided by debt plus equity, then what I would have done is I would have taken the total income available to investors and I would have divided it by the TFI. That's the number that Bloomberg would have given us if we had looked it up. 54.6. That's the number, if I go back to the CSX assignment, that's this. The ROIC in Bloomberg is the return on the debt and equity. What would we call that here in this class? The return on the what? It's not the ROIC. what they call ROIC, we would call return on,
Operating.
they call it return on the invested capital, but we have invested capital as operating. They include debt and equity together. Return on debt and equity is the return on TFI. So what most of the world is actually doing is they're doing what we would call a return on the TFI. And where they make a second mistake is the actual definition that Bloomberg uses is they take the NOPLAT and they divide by the TFI. Because they don't even take the total income available to investors and divide by TFI. They take the NOPLAT and divide by the TFI because they exclude the non-operating items because they're doing the return on the debt and the equity. But as I said, if you're doing this, you should definitely exclude that, which is why we're doing the operating return on invested capital in this class. But then we have the non-operating return, and that gives us the average return. As I said, it's a little bit more consistent approach. So I'm not asking you to go to any other faculty member and telling them they're doing it wrong. That will not be good for you. But I'm just saying when people do things differently, I'm just saying, just like I said, we take shortcuts. People take shortcuts in the real world. People take shortcuts in the textbooks that have been written. You should at least understand conceptually what the shortcut is and what it's actually trying to tell you. And that gets back to the storytelling. The number's telling you a story. And often when we did the CSX story, we're doing the return on the operating and non-operating. Why do people like rails? Because rails got some non-operating assets. You throw that out, and the railroad industry probably looks more attractive than what we said, and the railroad industry probably is more explainable given the forces that we originally did before we had to lower the forces. So again, it can actually give us more insight into what's happening with the firm. Okay? All right, here's your homework assignment for next week. Individual. It's worth 3 points. So basically, for homework 2, and it's available right now, there is, and I only posted the actual homework, I didn't post the solution yet, is these are the statements. And you'll notice they're more complicated. Okay? So it's a full income statement, which includes the dividends. Remember, the income statement actually ends here, and I gave you the dividends from the cash flow statement, so you didn't have to go to the cash flow statement. Gives you a full balance sheet and an assumed tax rate of 30%, not 25%, and a cost of capital of 9, not 10. So I usually will vary those from assignments, make cutting and pasting harder. And then we gave you that formula for Capex, and I said use BOY for ROIC and economic profit. And I made your life a little bit easier, and I gave you all the labels, the 1, 2, 3, 4s. So you got 3 years worth of historical data. So basically what you have to do is turn this into the same multi-tab spreadsheet. So you got to do the 4 statements: TFI, TII, CFI, economic profit, just like we just did. You'll basically take that spreadsheet, get everything to balance, upload it, you're done. That's your homework. Okay? It's individual, not a group assignment. All right? And then I will take what we've recorded in class today, I will post this on YouTube. So
Including the
basically,
Excel sheet that you filled.
I'm sorry?
Including that Excel sheet you filled.
And I will post a copy of this Excel spreadsheet that I just filled out with all the equations and stuff. I'll post that to the file section of Canvas as soon as we wrap up this video. Yep.
Canvas won't take Excel, you just want to copy and paste it in Word.
Actually, Canvas will take Excel. What I did is I restricted on the first assignment to doc and PDF because I didn't think anybody would do an Excel. So that was my fault. But on this one, I'm actually going to restrict a homework assignment to just Excel, because obviously you shouldn't be turning in a Word document for these converted files. So basically just make sure you convert everything, make sure you get it to balance, upload your Excel file. That's homework 2, and that's what I will grade. Okay? But again, good question. Any other questions? All right, we'll see everybody next Saturday. And if you have any questions as you're struggling to do this, email me throughout the week.